As an insurance agent, one of my primary focuses in my work is helping people protect their assets, whether it's a home, whether it's an auto. We also work on trying to protect individuals' money. Now, what I would want you to know is this. Right now, there's a lot of fear out there about a recession, about the economy, and about bank failures. And bank failures are nothing new. In 2008 and 9, we saw major banks like Washington Mutual. We saw brokerage houses or investment banks like Bear Stearns and Lehman Brothers go out of business. And it was terrifying to go through that time if you owned a home or if you had a job in those types of sectors, or if you had a lot of retirement that then dipped really low because the stock market went down, housing prices went down. We may be at a time like that now. We may not be at a time like that right now. We don't really know. What we do know is that there is always inherent risk, and you need to know how to protect yourself well in these types of situations. And I'm going to give you a couple of different ways to protect yourself that seem very simple. They seem like common sense. However, sense like that isn't too common these days. So first, you should know that if you have under $250,000 in any one bank, and it's in a checking account, savings account, CD, that money is secured by the FDIC. That is the federal backstop to sort of make sure that individuals that have a bank like, let's just use First Republic, if a bank like that fails, automatically anybody who has less than $250,000, they can have that money reimbursed to them through the FDIC. That's a way for the country to protect normal individuals and make sure that they don't lose their money if the bank was to fail. That didn't happen with First Republic Bank. That bank was going out of business, and the process of changing it over to JP Morgan Chase was the solution that the Federal Reserve and the FDIC worked out along with Treasury Department in order to figure out a way to keep the bank open under a different company's name and allow JP Morgan to invest or influx money into that bank in order to solve the problem that they were having. So if you are putting money away or have money in your bank, that's the basic insurance principle that will happen. The FDIC will work to protect up to $250,000. But there are other ways for you to protect your money. For example, during this time when inflation is growing, we're seeing expenses rise. It's a good idea to create a budget that would put your money down on paper. You know where every dollar is supposed to go, and begin trying to save as much as you can so that you have a buffer against the unexpected. And there are lots of unexpected things that can happen during recessionary times. We've seen massive layoffs. We've seen lots and lots of companies tighten the belt. And as an individual, that's a good opportunity for you to do the same thing. That is a way for you to protect you, your family, your financial situation. Don't depend on credit cards, or don't depend on other types of savings like your 401k and dipping into that. Build up an emergency fund. You want to have 3 to 6 months of money in the bank in order to pay for expenses if you were to have them. In that case, you have a budget that you have the ability to then adjust. You have the budget written down on paper. You have a savings of 3 to 6 months of income. And if something goes wrong, if the banking system or any type of economic circumstances hit, you have hedged yourself with the best resources you can. You know where your money is going, and you know you have money to take care of you for a longer period of time than 10, 15 days. So building up that emergency fund and making sure you know where your money is going are key. The other thing you want to be able to do is cut costs. You want to figure out what are the things that you could do without immediately if you needed to. Go through your banking statement over the last, let's say, 45 days. See what charges have come out for things that are reoccurring. So, for example, you have a Netflix account, you have a Hulu account, you have a Disney account, whatever it is. you may want to stop one of those and save the $9 to $15 that you may, spend on that monthly. Maybe you thought you had canceled it and it still is coming out. There are easy ways to figure out those subscriptions that you are automatically paying for every month. Taking a look at your 45-day banking statement history and just pulling up any reoccurring accounts. You want to do that and figure out how to get a handle on those small things that end up building up into big things. And for every dollar that you save on that is a dollar that you can put into that savings account for your 3 to 6 month emergency fund. Now, these all sound very simple, and I would come to you and I would remind you this, that most people don't need to be taught, they need to be reminded. And we're the same way with our financial statements and our financial lives. We really know what leads to success. The challenge is putting it into practice day after day after day. And I hope this reminder has helped you with a basic framework for how you can prepare for the financial challenges that we may see over the coming months. Hope you're doing well. Take care.